This is the Age of Trade. I'm Paul Allen in Sydney, where the market has just opened. The top stories this hour. Panama rejects Donald Trump's threat to reimpose US control over the Panama Canal after Trump accused the waterway of high transit fees on US ships. Bond traders look to 2025 after the Fed's easing cycle leads to a surge in 10-year Treasury yields. Pepperstone will be giving us their investment strategy. Plus, how China has become one of the reasons for a potential merger between Honda and Nissan. All right, markets just opened here in Australia for, well, the final trading week of 2024, and it will be a shortened week as well. Staggered open, of course, so hard to get a read on things, but we're up by just a few points in the early going here. Taking a look at Nikkei futures, they're poised to the upside also by 0.1%. We did see the Nikkei close lower on Friday, along with all the major indexes in the Asia Pacific. Keeping a close eye, of course, on the yen, 156.54, a little bit stronger than what we saw last week when it slipped to a 5-month low. We did have the currency chief in Japan warning on Friday against currency speculation and hinting at possible intervention. No surprises there. Japan's government spent close to $100 billion supporting the yen this year so far. Also got a very soft Chinese yuan there. Let's take a look at how US futures are tracking as well. We did see US markets close off last week. All the major indexes were 1% higher, better than 1% higher, and we're seeing E-mini futures better by 1/3 of 1% right now as well. As we get to the end of the year, of course, there's always some interesting superlatives around how markets have been performing. The S&P's up 26% this year, but a few ETFs that compete with it. The God Bless America ETF trades under the code YAWL. Beat this. It was up almost 33%. A fund tracking securities bought and sold by Democratic Congress members called NANC, short for Nancy Pelosi, was also up 28%. So if you traded according to your political views, you would have done even better than the S&P in 2024. Dollar spot index continuing to show strength, up another 0.1% there. And we've got an oil price right now, New York crude 69.48. Oil in the last quarter of this year has been trading in the tightest range in 4 years. That's for Brent at least. Of course, OPEC continuing to reduce output due to reduced demand. All right, casting a shadow over all of this, of course, is what the Fed does next. We heard from Mary Daly, San Francisco Fed chief, a little bit earlier. Here's what she had to say.
And today, I feel like we've got policy in a good place, the economy's in a good place, and we're prepared for whatever comes before us. My projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
All right, Mary Daly there talking about her 2 cuts still on the table for the Fed next year. Just want to get to one of our other top stories as well. This is Donald Trump's remarks on Panama. Of course, he was complaining over the weekend about the excessively high fees being charged to U.S. ships transiting the Panama Canal. We have heard from Panama's president, Jose Raul Mulino. He rejects Trump's threats to reimpose U.S. control over the Panama Canal, which was gifted to Panama under the Carter regime. Mulino says, well, he's defending the canal's tolls, saying they're established transparently based on operating costs and market conditions, and he's rejecting this idea of the U.S. taking it back, saying the canal is controlled exclusively by Panama. Donald Trump, meanwhile, has responded, saying, we'll see about that. All right. Joining us now, we've got Chris Weston, Head of Research at Pepperstone Group. Chris, President Trump is still President-elect Trump. He's not in office yet, but we're already getting a reminder of his unconventional approach to politics. How are you factoring in this unpredictability when you're thinking about strategy for 2025?
Well, we've got to consider how we're going to sort of source news and how that's going to sort of feed into, people's dissemination of where they're going to get their news going forward. Obviously, there's going to be more of a sort of a deciphering of signal versus noise for investors, and obviously algos are going to react far quicker to any news that comes out of Truth Media or any of the other places as well. So I think the way that we source the news, the price discovery obviously is going to change, and that's already started now. So that's something that we're going to be watching, especially when we get into the pointy end of negotiations. On the trade side, people want to understand what is bravado and ultimately what is actually really happening behind closed doors, because I think the two things could be very, very different factors, and where we end up with tariffs, of course, is going to be another situation. So, yeah, I think we're just the way that we consume news and how we actually create the signal versus the noise, I think is going to be a major challenge for 2024 and 25, sorry, and I think that's something that, I think people are far more conditioned to deal with these days.
Yeah, and of course that news flow comes from owned media platforms, social media platforms, and it often comes at such a pace that it's hard to keep up with. And it was just a few days ago we had Trump airing his desire to get rid of the debt ceiling. Now, this is an idea that actually has some sympathy among some Democratic members of Congress as well. But I'd like to get your thoughts on this. US deficit, debt, it's already taking on rather concerning proportions. What are the risks around getting rid of the debt ceiling entirely, and how much debt can the market soak up?
Well, I think it makes a lot of sense for him to try and push this as he comes into office, because I don't think he'd be saying the same thing if Kamala Harris had won the election in that situation, because they want to have some fiscal restraint. But I think that's where we are at the moment. We all know how the debt ceiling is going to go. We'll go to the wire. We suspect that will obviously take place on January. We would probably likely to see by August them sort of depleting, some of their extraordinary measures, and then it becomes obviously more of a markets issue. And we say, what if, and we go further down into the really pointy end. But we know how that will be resolved, and there may be some small anxieties going into that point. But of course, in this situation where public debt in the US continues to go up at a rapid clip, and fiscal support has obviously made such a huge impact on US GDP and the labour markets and various factors, we are watching this very closely. But of course, as I say, I don't think he'd be making these noises and looking to change the debt ceiling dynamics if he wasn't president.
Yeah, for sure. And in this environment, we've got yields rising in the US as well. Where do you see them heading in 2025? Could we potentially have a 5 handle on the 10-year?
It'd certainly be an outlier call. I mean, I think they will be. I think the discount rate will make more of a difference as we go into the new year. I certainly think we see 10-year real rates pushing above, what was the high we got back in mid-year, in October of last year, we got up to sort of 258. I think if we were to break that, and of course it's the rate of change that everyone watches. It's not just about the absolute level, it's about the pace that we have. And I think that's where if we're trying to price equity risk and look at the equity risk premium, and especially with the time when valuations are so stretched, I think it's the pace of change in the selling that we're going to be seeing. So I think that people are making the argument that, long-end yields, 30 and 10-year yields, which obviously seen some big volatility of late, are starting to look a little bit cheap at current levels. But you wouldn't necessarily go out and buy duration just because of valuation risks, given the ferocity of the move we've been seeing. But I think they will matter as we go into 2025, and trying to price risk around what's happening in the long end, I think is absolutely key. But I think 5% would be an outlier move. I know I certainly, speaking to a lot of fixed income investors who are very, very keen to pick up, 10-year treasuries above 5% if we were to see those levels. I think there's going to be big demand, but obviously we want to see what the world looks like if we were to get to that point. But I think above 5%, I think you're going to see, duration assets, equities, and sort of tech and those kind of plays, I think will struggle pretty heavily if we get to those points.
We heard from Mary Daly there a moment ago as well, talking about how she's comfortable with 2 rate cuts. But that decision and commentary from the Fed last week really left the door open to some conversation about whether we end up with 2 cuts or less, or possibly a hike as well. But, if we think about this, there's sticky inflation, there's strong growth. Why ease in that kind of environment?
Yes, it could. I mean, it's obviously the point of conjecture at the moment. I mean, I think it's still very much a moving target. I think the Fed have had so many whipsaw moves over the last 15 months. I think we've seen 5 major pivots from the central bank, or major, but certainly pivots from the central bank. But I think it just goes to show that their visibility on some of these academic terms of R-star, or both on a nominal or real R-star basis, I think is very, very poor. And they're still very much a data-dependent central bank, and therefore the market is still has very low understanding about where the Fed really want to go. So it's still very much a moving target. Their dots were marked to market to where Fed for market pricing is. you go back to the idea about where treasuries can go. I mean, I think at the moment, you've seen the SOFR rate for Reds moving up to about 4%. So that's your trough. I mean, I don't think 10-year 10-year yields are going to get much lower than 4% in this environment. And I think that's the point where you'd certainly be aggressively looking to short treasuries should we get to that point in the future. But yeah, the Fed have got very low visibility on where things are going. I think they've made that pretty clear by incorporating, the trade tariffs into some of their forecasts as well. And so I think we just have an open mind. I would say at the moment that the 2 cuts seems okay. I think the market seems okay with that situation. What we've got 34 basis points of cuts being priced into SOFR futures for next year. I think that tells you that the market is open to the idea that we could get no cuts, or we could get 2 or even 3 cuts. So it's very much a moving target. The Fed are data dependent. We're going to have to watch really the payrolls number that comes out early January, and then the CPI number. And I think then we'll get a clearer picture about how that market pricing's looking.
All right, Chris Weston staying with us. Chris is, of course, head of research at Pepperstone Group. We'll continue the conversation in just a moment. But we've got some breaking news out of Australia now. We're hearing that News Corp intends to sell Foxtel to Ghosn for an enterprise value of 3.4 billion Australian dollars. Now, this has been an idea which has been discussed since early this year. Around August, News Corp it was made public that it was considering selling Foxtel. Foxtel is, of course, a legacy pay TV service here in Australia. It's struggled against the emergence of many streaming platforms, including Netflix and the like. Newstalk has resurrected Foxtel. You don't need a Foxtel subscription or a cable now to watch sports, for example. It has its own streaming service for that called Kayo. But this was expected to be in the pipeline, and now we have the news. News Corp to sell Foxtel to Ghosn for an enterprise value 3.4 billion Australian dollars. All right, we have more ahead on the Age of Trade. This is Bloomberg. China's property sector is hearing alarm bells again as the debt crisis enters its 5th year. Last week, banking regulators told top insurers to report their financial exposure to China Vanke, one of the mainland's leading developers. For more, let's bring in our China correspondent, Min Min Lo. So, Min Min, how wide and deep is the property crisis now?
Well, China Vanke is the 4th largest property developer in China, and so it's quite concerning given that it is one of those big builders that have so far managed to avoid default, but it is now on the radar. And it's not just China Vanke. If you look at in Hong Kong, we have New World Development that is seeking to delay payments for some of its maturing loans, some of the biggest debt burden of its kind, because it has about $28 billion in liabilities as of end June, and it's facing its first annual loss in about 2 decades. And plus, you have Parkview Group, which is putting up this iconic mall in Beijing that is largely empty for sale. So if you look at overall the amount of bond defaults so far, it has come down from the peak in 2022, but it remains quite elevated. And the fear is that the contagion will spread to offshore to Hong Kong as well, where the market correction is still ongoing, and analysts expect that the market could still take another 1 or 2 years to bottom out. We can expect more defaults to come in the next 1-2 years.
How unusual is it that regulators are asking insurers to check their exposure to certain companies like this?
Yeah, it is getting a bit of attention because remember, policymakers had just sat watching when China Evergrande, Country Garden were defaulting. But this time, analysts still think that the possibility for government bailout of China Vanke is quite low, below 50%. We know that Vanke executives have been visiting several insurers in the past weeks, asking them not to exercise the put options on some private debt that would soon become open to the firm. But yes, Jefferies Financial Group, for example, saying that the liquidity shortage for China Vanguard could come earlier than expected. If financial institutions become more cautious and ask for more collateral at a time when home sales continue to slump, asset disposal has been quite slow. So if you look at the dollar bonds for Vanguard, it's been slumping, which shows that doubts are increasing from investors about whether they can actually get full redemption of those bonds.
All right, Bloomberg's China correspondent Min Lo there. Let's get back now to Chris Weston, head of research at Pepperstone Group. Chris, as we're hearing there, China's property woes, rather than going away, just seem to keep metastasizing. How's your risk appetite for China right now?
I mean, it's pretty poor, like a lot of people. I think, you know, if you look at the various indices, they've just been trading in a tight range. I mean, sort of CSI 300, not that I get access to that, but yeah, that's sort of been trading 4,200 down to 3,800, and that continues to be the case with a lot of the markets you can get access to. So really, for me, until you see more of a sort of a trend and a one-way trend coming through, then that's probably what I want to be involved with. Obviously, we're looking at the yuan as well, and yeah, there's a general sort of consensus trade that once tariffs are implemented and we actually understand the meat on the bone, like we saw in 2018, when actually the facts are known, then they'll start depreciating the yuan in a more sort of readily fashion. But yeah, implied volatility and realised volatility in the yuan is still very, very low at the moment, and I'd like to see it a little bit higher. But I think it's going to be an interesting place to be. I think if it's going to be one of the big macro thematics of Q1 into Q2 going forward, because expectations have been hosed up so many times, and then obviously we are disappointed, and obviously everyone's got their eyes on the MPC meeting in March. To get that clarity, to get that substance. And I think, that they'll need to understand the facts about the external shocks around tariffs before they can actually make up their mind and really go hard on whether they need to really boost domestic demand. I think the worse things get on the external factors, the more they'll have to use domestic demand to drive domestic demand as a policy lever. And I think in that situation, China could be very, very interesting in a market that is underloved. Obviously, there's not very much international flows in there. And so if they can actually pull a rabbit out of a hat and give people the confidence, not just that they're going to meet the growth rates going forward, but they can actually create animal spirits. And obviously that's a big if, but that's where expectations are. And if we were to see that, I think that's huge implications for asset allocation in 2025. But we probably won't know that until sort of the mid to late parts of March. But I think, you may see some tradable rallies. Is it investable? Not sure yet, but I think it's definitely tradable, and you're going to see some life and some big volatility in China, which will interest me. We're not there at the moment. As I say, we're in a pretty tight range in a lot of the Chinese indices, but I think my base case is at the moment, and obviously the market will tell me when they're feeling that, is that we will see some bigger trends up or down and big momentum moves. And I think if that is your strategy, I think China's going to be front and centre next year.
Yeah, well, you mentioned there tariffs almost as if they're a fait accompli, like you expect them to happen. I think everybody does, really. But perhaps it's a reasonable expectation to think that China's going to step up support both for the economy, for markets as well. And if we take a look at this chart that we have on the Bloomberg, you won't be able to see it, but I'll describe it to you. I mean, thanks to stimulus, China's stocks have outperformed the region in 2024. So does that give you any degree of confidence, if not stirring animal spirits, perhaps that, well, China's always going to be there for the market?
Well, they obviously had the big rally going in September. We saw that significant move, and I'd love to see something similar to that. I'm not sure where I'll get it, but I obviously they've given us some pretty clear messages that they want to do what needs to be taken. Obviously, they changed their view on monetary policy, and then they've also told us from semantics perspective that they want to have a deficit of 4% of GDP, which didn't really surprise anyone. But I think that is a clear message to people that they're going to do what needs to be done. But I think the Chinese work in a different way from a lot of other different markets, and that is they wait for the facts. They wait to understand real clarity before they set policy and to detail that to the market. And because obviously they've got the closed capital accounts, we can't really front run that certainly in the currency market like we can do in the Mexican peso and a lot of the other currencies there, which are subject to tariffs. But I sit in the base case at the moment, and I'll wait to be seen that Donald Trump is going to play very hardball. He's going to be seen to be going back to his voting populace and saying, I've fought really, really hard for your rights, and I've basically come out and I'm ahead and I'm winning this one. But I think what happens behind closed doors, I mean, he's won the election because of the cost of living, and he's not going to want to really hurt the cost of living too much, and that means, fine, we're going to get tariffs going up and the price level will go up. But I think what we've seen from forward inflation expectations, five-year break even, is very, very well anchored. And of course, the Fed know that and have detailed that. And that's a reflection that he will not want to derail the inflation process through actions of his own. And I think it makes a lot of sense then that what actually happens and what we end up, the final point will be far less onerous than what he's campaigned on. So this idea of 60% tariffs on China across a broad range of goods, I don't think it will get anywhere near that point, to be fair. And I think that just sort of feeds into my point that an underloved position on China, if they can do what needs to be done on stimulus and tariffs not being as high as what people expected, I think you could see a strong rally in Chinese markets, which has really big implications, not just for commodities, but in Australia, people have been going into banks because there isn't a liquid vehicle for a lot of the institutions to go into the materials stocks. I think materials may have a better 2025, but of course it comes with risks, and positioning for that right now is very, very aggressive.
Yeah, in terms of materials, we've had some forecasting from the Australian government that the future for iron ore might not be terribly bright in 2025. Yeah. But Chris, before we let you go, I do just want to talk a little bit about the dollar. I mean, that's another Trump policy, is to ensure that dollar supremacy is never undermined, and that certainly seems to be intact at the moment. But what about dollar yen? Where do you see that going? Because the Japanese government's thrown about $100 billion at defending the yen in 2024. Is that going to continue next year, and what's the path of least resistance for the yen?
I think we're still going to take a view on relative rate settings. Relative growth is obviously really important, and I think this idea that the MOF are going to be out on the wires talking about this disdain for currency moves is still something that's going to have. We're going to see lots of pockets in 2025 because there is good trends and there's good volatility in dollar yen, and that makes it very attractive as a trading vehicle. But I think, we don't talk necessarily absolute levels. I think we probably do need to see dollar yen above 160 if we were to see that. But it's the rate of change that obviously they want to try and suppress. And with the move that we've been seeing in US real rates into 220 or so, and the backup in longer term duration, I think is obviously something that has put an upside bid into dollar yen. We go into the Bank of Japan policy. We're looking at the next meeting on the 24th of January. The market's sort of 50-50 whether we get a rate hike in that. But everything we've seen from the Bank of Japan at the moment has been wait and see. No need to rush. And again, that's just frustrated yen bulls every single time. So do we get that hike? I think it's still, the jury's out on that one.
All right, Chris Weston, Head of Research at Pepperstone Group, thank you so much for joining us today. We have more ahead on the Asia Trade. This is Bloomberg. Let's check in on how News Corp shares are tracking here in Australia, better by almost 1.2%. This is on the news. We mentioned earlier that it's agreed to sell its cable TV business Foxtel to Ghosn in a $3.4 billion Australian dollar deal. That's $2.1 billion US dollars. We're learning a little bit more about this. Under the terms of the agreement, shareholder loans valued outstanding at almost $500 million Aussie, more than $500 million Aussie, will be repaid in full in cash, and News Corp will get a seat on Ghosn's board of directors. So the sale of that legacy cable TV business underway for News Corp. The market likes that news. We have more ahead on the Asia Trade. This is Bloomberg. Let's take a look at how we're tracking here in Australia after 30 minutes of trade. The ASX higher by almost 2/3%, reversing some of those losses that we saw towards the end of last week. One of the best performing stocks right now, News Corp, better by 1.3%, as we mentioned this on news of the sale of its legacy cable TV business, Foxtel. Also see there that the Australian Exchange says issues with its settlement system are now resolved. There were some difficulties with that on Friday. But the restart of that system, known as CHESS, has been delayed a little bit. It's not going to be up and running again until midday, but CHESS will be available today, according to the Australian Exchange. Well, San Francisco Fed President Mary Daly says she's very comfortable with 2 rate cuts in 2025. She told Bloomberg that Donald Trump's proposed policies will not be the factor that guides her forecasts.
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we're prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that there's 2 things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress is just slowed relative to what we had wanted. But that's a typical pattern. It's bumpy. As you get to the, from 2.5 or 2.8 to 2, it's just a bumpy path. Yeah, go ahead, please.
So at the same time, some people were wondering if there was this stickiness. And I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. Remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. Was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We've practiced that where with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
That's San Francisco Fed President Mary Daly there. Let's take a quick look at markets. As mentioned, here in Australia, the ASX having a reasonably positive morning. We've got Nikkei futures, meanwhile, also in positive territory. And this follows a pretty strong end to close out the week for US markets. We did see all of the major indexes in the US close more than 1% higher on Friday. We're getting some news out of South Korea, meanwhile, that the country may lower its 2025 GDP growth forecast to 1%. Sticking with South Korea, President Yoon Suk-yeol's fall from grace is building public support for his biggest political rival, Lee Jae-myung. Bloomberg's Yuk-hyung Lee joins us now. So, Yuk-hyung, who's most likely to be the next president if the Constitutional Court supports the impeachment of President Yoon?
Sure. So the strongest contender to be the next president in South Korea right now is the opposition party leader Lee Jae-myung, who is Yoon's rival. And Lee is a former labor activist, and he has run for presidential elections in the past and has lost. But this time, the public support shows that he is most likely to be the next president for South Korea. But he's also facing his own legal challenges. So after South Korean court found him guilty of violating election laws, so for Lee, he has appealed the court decision, but it's really for him, it's really important whether the Constitutional Court delivers the impeachment ruling before the appellate court delivers the ruling on Lee himself, so that he could be able to run for the snap presidential election. If the appellate court found him guilty again, Lee may be barred from seeking office for the next 10 years. So Lee is also facing his own legal challenges, even though he's seeing a very high public support at the moment.
Yeah, certainly a lot of uncertainty, upheaval in the South Korean domestic political scene. With that in mind, what should investors be watching this week?
Yes, there are two big things that investors should be watching this week. One is the investigation on Yoon and whether the impeached president Yoon will be show up for the questioning to investigator, which is scheduled on December 5th. But the investigators have trouble delivering the summary request for Yoon, and if they is having trouble delivering the summary request to Yoon, and you may not show up to the question, they might invest in which is setting an unpredictable value for the and the other front related to that is that what opposition party, whether opposition party makes.
Yukyung, we're having a few difficulties with your audio there, so we might come back to you a little bit later on. That's Bloomberg's Yukyung Lee there. Some of the other stories that we're following: Taiwanese President Lai Ching-te is facing growing challenges to his leadership amid tussles between his ruling DPP and opposition parties. Members of the DPP on Friday piled furniture to block the entrance to the legislature in Taipei. Even so, opposition parties managed to push through new amendments, including a law that could make it more difficult for the Constitutional Court to strike down legislation. A German judge has ordered pre-trial detention for a man suspected of driving a car into a German Christmas market. The incident left 5 dead and dozens more injured. The 50-year-old man has been identified as a doctor of Saudi Arabian origin who works in the region. Authorities are investigating his potential motives, including earlier warnings from Saudi Arabia. UK Prime Minister Keir Starmer's pursuit of closer ties with China to boost the British economy is raising private questions from officials. Sources say President-elect Donald Trump's team, as well as European diplomats, are questioning his stance on China. Last month, Starmer became the first British Premier to meet Chinese President Xi Jinping in 7 years. We have more ahead on the Asia trade. This is Bloomberg. Oh, we've got Japanese markets opening at the top of the next hour. We've got Nikkei futures in positive territory at the moment, following on from some pretty good gains that we saw on US markets towards the end of the week. We've got a very weak yen, though, still 156.46. Unsurprisingly, perhaps, had the currency chief in Japan warning on Friday against speculation, hinting at possible intervention, so we'll be keeping an eye on that. The yen right now, 156.46. Well, Carlos Ghosn, the architect of the Renault-Nissan alliance, says merger talks between Nissan and Honda suggest Nissan is in panic mode. He told Bloomberg that while there are similarities between the firms, cooperation between the two companies is going to be challenging.
It's a desperate move. It's not a pragmatic deal because, frankly, the synergies between the two companies are difficult to find. There is practically no complementarity between the two companies. They are on the same markets. They have the same products. The brands are very, very similar. So in a certain way, from one side, Nissan, it's a desperate move to try to find the future. And from the other side, Honda, which, if I understand well, they were not very excited about this move. But, you have to count with METI in Japan. That means the METI had a big say into it. So at the end of the day, they're trying to figure out something that could marry the short-term problems of Nissan and the long-term vision of Honda.
Do you think Nissan is being put? Do you think Honda is being pushed into this deal by the economy ministry? There's politics pushing this deal, Carlos, rather than the value of the deal.
Without any doubt for me, that means having lived in Japan for so many years, I understand how influent can the METI be. And I can tell you that from all the data that I received about the performance of Nissan, which has been miserable for the last, at least for the last 2 to 3 years, they have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that there is panic mode inside Nissan. You've
dealt with the Japanese, you've dealt with Nissan, you understand the metrics to get these organizations together. Is the government going to have to deliver backstops to Honda to make this deal work? No, I think they in a certain way, tried to push Honda onto this deal. Obviously, Honda must have some kind of benefit out of it, if not on the short term, at least on the mid and the long term. But that will be closely monitored to make sure that the impact on the Japanese society is not going to be too big. Because, when you have two companies of this size and practically in the same market with practically the same strengths and the same weaknesses, there are going to be a lot of costs to be taken out, and there are going to be a lot of duplication to be taken out. So this is going to be closely monitored by the METI. It's driven by the Ministry of Economy. So there's a political dynamic to this. Is this Japan creating, putting two companies together to really try and stand up to the competition from China? Is that part of the narrative here, Carlos? Without any doubt. It makes a lot of logic. Today, the Chinese automakers are on the winning side. They became, as you know, the largest exporter of cars. They are the largest maker of EV. They are being successful in a lot of new technology. They're doing fine cars. So in a certain way, yes, it's a defensive mood. It's a defensive mode that's going to be trying to shore up the Japanese industry and avoiding a cataclysm, first a social cataclysm in Japan, and particularly to try to reinforce these companies on the foreign markets.
That's former chairman and CEO of the Renault-Nissan-Mitsubishi Alliance, Carlos Ghosn there. Now, staying on Honda and Nissan, and the situation in China is among the reasons for the two firms to enter into merger talks. Our transport reporter Nicholas Takahashi joins us now. So, Nicholas, tell us about the capacity issues in China, how this is really forcing the situation for Nissan and Honda.
Right. As Mr. Ghosn just explained very well, China's been a bit of a bloodbath for legacy car makers like Nissan and others as well, Toyota, Honda, GM. Across the board, the rise of EVs in the world's biggest car market have been forcing out other brands that we all know very well to the sidelines, if not over the edge. And in Nissan's case, sales in the US and China have been particularly painful. Led to a big cut in its annual profit outlook earlier this year, plans to lay off thousands of workers and cut back production. So in the background of all this talk of a merger with Honda is growing local competition in China, and especially on EVs.
Yeah, as you say, this problem not unique to Nissan and Honda. General Motors has been having some difficulties there as well. What does the future hold for foreign car makers in China? Can we expect to see more consolidation, more reversals? What are we anticipating in 2025?
I think that's the general consensus, is this trend of consolidation of the smaller players joining hands to compete on a bigger stage in China, especially with big brands like BYD, which is gaining so much market share at such an alarming rate. And so we're seeing big car makers, big brands that we've known as household names for years now, sort of looking to each other to build out capacity, cut down on R&D expenses, maybe overlap staffing as well, and to join hands so that they can survive in China and then continue to thrive elsewhere.
One imagines that this issue of Chinese EVs is firmly on the radar of incoming President Trump. What sort of difficulties could Chinese car makers face in 2025 once he assumes the presidency?
Well, next year definitely bodes a challenging year for car makers of all types. I mean, talk of tariffs on Chinese imports is a complication for Chinese EVs. Not only that, talk of tariffs from imports across the Canadian and Mexican borders are raising alarms here in Japan as well. Honda, during earnings last month, an executive said that tariffs for imports over the Mexican border, across which Honda imports hundreds of thousands of vehicles every year, could be very painful. So as these tariffs take hold and start to materialize over the next months, if not years, the details are going to be important here. But that could largely impact the books and the balance sheets of these big car makers that rely heavily on production in different parts of the world, different parts of their own countries, and to continue competing in North America, which has been a really volatile market for the past couple of years.
All right, our transport reporter Nicholas Takahashi there. And you can catch Japan Ahead every Monday, 8:40 a.m. if you're watching in Tokyo. That is 7:40 p.m. on Sunday in New York. And subscribers can watch live on the terminal function, on the terminal, using the TV Go function. Other stories that we're tracking from the corporate front. Chinese EV maker NIO has launched its most expensive car as it looks to double deliveries in 2025 and become profitable. The ET9 battery electric four-seater sedan priced from $108,000. It can travel 650 kilometres on one charge. The car is set to take on Porsche's AG's Panamera series and Mercedes-Benz's Group AG's luxury S range. Singapore Post has fired its CEO and several other senior leaders after a whistleblowing report related to its international e-commerce logistics parcels business. It alleged several employees submitted information with the intent of avoiding contracted penalties with one of Singapore Post's largest customers. The firm says it will pay a settlement to the unidentified customer. OpenAI has unveiled a new AI model that can perform more advanced human-like reasoning and solve complex problems. The O3 model will be released early next year, along with a smaller version called the O3 Mini. The release ratchets up the competition with its rivals as other AI developers push ahead with increasingly advanced technology. We have more ahead on the Asia trade. This is Bloomberg. Australia's new targets for carbon emission cuts are expected to be delayed by several months as a result of Donald Trump's return to the White House. For more, let's bring in Australia government reporter Ben Westcott. So Ben, when does Australia need to reveal its 2035 climate targets?
Well, thank you for having me, Paul. Yes, so Australia is required under the Paris Agreement to reveal its planned cuts for 2035 by as early as February next year. However, there has long been speculation that the government would probably seek to delay that revelation of those cuts, given the fact that they're facing an election around that time, and climate action is always a very heated topic in Australia. So what we heard over the weekend was that the Climate Change Authority, whose job it is to give the government a recommendation of what those cuts should look like, and then the government will then turn that into legislation, has said that they would like to postpone that decision on what the climate cuts will look like by just a few months, given the return of Donald Trump to the White House and the policy uncertainty that creates around the world.
Yeah, so tell us a little bit more about that policy uncertainty. Why is that playing into this plan for a potential postponement until later in the year?
Yeah, so Energy Minister Chris Bowen actually laid it out on radio this morning, and it comes from two directions. It comes from one direction where obviously the US president, or the incoming US president, has made it clear that he's not very keen on the Inflation Reduction Act, which pours a lot of money into green energy and renewable initiatives. So if he is able to wind those back, that will create uncertainty in the investment space. But there's another side of this as well, which is that Australia is very keen, if Donald Trump does wind back those green investment policies, wants to take advantage of that and get some of that investment pouring into Australia, given that Anthony Albanese, the Prime Minister, has repeatedly promised to make Australia a renewable energy powerhouse. So the idea is on both sides, there could be some uncertainty, some downside from the winding back of the Inflation Reduction Act. However, on the other hand, there might be a possibility of some advantage for the government and for the Australian economy from getting some of that investment into the country.
Well, we've got an election coming up next year. We don't know when exactly yet, but does this have any significance related to the upcoming poll?
Yeah, absolutely. So if the Climate Change Authority does push back its recommendation by a few months, that puts it into at least March at the earliest. Now, Australia has to hold an election by May 17th, which would mean at the very latest calling it by about April 12th. Which almost certainly rules out the likelihood of the government announcing its policy for 2035 before the election. Now, that has long sort of been expected, just given the fact that climate action has long been a very fraught issue in Australia. Whether or not we tackle the climate cuts through renewable energy, through gas, through coal, through nuclear, has been a political matter that's toppled multiple prime ministers. And so I think the government was looking to not have to say any big numbers ahead of the election. Things like, there was a suggestion that the cuts could have been 65% or higher by 2035 off 2005 levels. So they're basically looking at not having to put any big numbers ahead of the electorate before the upcoming vote.
All right, Australia government reporter Ben Westcott there in Canberra. Let's take a look at cocoa prices. We don't do this very often, but wow, they've almost tripled. They're hovering around an all-time high of $13,000 a tonne. These gains have put Bitcoin in the shade, and that's saying something. Harsh weather, crop diseases in West Africa are partly to blame for this. Chocolatiers also have been sitting on the sidelines waiting for those prices to cool off a bit. Now seeing that they're not cooling off, they're piling in as well. So big pressures on both the supply and demand side for the cocoa price. Other commodities that we're watching, iron ore. The Australian government's forecasting $80 a tonne in 2025. That's a pretty steep decline from the $100 plus prices we're seeing at the moment. That goes down even further to around about $76 a tonne in 2026. Take a look at the oil price as well. That's holding fairly steady at the moment, but of course lingering questions remain over the China demand picture for oil. The commodity spot index, meanwhile, better by about 1%. Market opens in Seoul and Tokyo. Up next, this is Bloomberg. This is the Asia trade. We are counting down to Asia's major market opens in Japan and South Korea. This is the final trading week of the year, of course, and it's going to be a shortened week as well, interrupted by Christmas Day around the region, also Christmas Day and Boxing Day here in Australia. So we might expect to see somewhat lower volumes. That said, we're seeing a reasonable start for the ASX here. We're better by about 0.75% in the early going. We're seeing a little bit of softness for commodity prices as well, unless, of course, we're talking about cocoa. We might get to that in just a moment. Right now, though, we're going to get first 20 days of trade numbers for South Korea imports and exports for the first 20 days of December, coming in at 6.8% uptick for exports That is an improvement on the first 20 days of November. A big reversal for imports. They're up 7.5%, and that reverses the contraction that we saw for the same period last month. We're also hearing some news out of Korea as well, that the financial and FX market volatility might expand in the short term, and South Korea will take steps to stabilize market sentiment if needed. We do, of course, have a Korean won hovering around 2-year lows. Right now it is tracking a little bit stronger against the greenback. Yeah, anyway, 1,445.92 for the won. We've got the Kospi there opening higher to the tune of 0.8%. The Kosdaq index also moving higher as well. Let's take a look at how we're tracking for other markets in the region. Also, we've got the Nikkei just opening for trade as well. Also a positive start there, as we were anticipating, better by 1% in the early going. Keeping a close eye on the yen, of course, because that's hovering around 5-month lows as well. It has strengthened a little bit from some of the levels that we saw last week, but right on cue, we did hear from Japan's currency chief, a warning on Friday against currency speculation, a hint at possible intervention. And as a side note to that, Japan has already spent close to 100 billion supporting the yen this year. Suggests in 2025 it might have some more work to do as well. Here in Australia, meanwhile, also a positive day on the ASX. We're better by about 0.75% at the moment. One of the big movers, of course, News Corp, better by 1.7% on the news that it's going to sell its legacy cable TV business, Foxtel. The market warmly welcoming that news. Got the Aussie dollar pretty much flat against the greenback at the moment. Quick look at the oil price as well. That's holding fairly steady as well. We've seen Brent trading at its tightest range in 4 years. Of course, OPEC continuing to reduce output due to reduced demand. All right, let's get to our guest for this hour. Clark Geranen is Chief Market Strategist at CalBay Investments. Clark, we're seeing a reasonably good day for Asian markets so far this morning, but if we take a look back across 2024, we did see US stocks outperforming the world last year, and in fact, in most years since 1996. Do you anticipate this outperformance from US stocks continuing for the next 4 years, particularly considering the uncertainty around the trade environment?
We do. So over the past 2 years, we've seen more than 20% growth in the S&P 500, which hasn't happened in over 20 years. So we're looking at interest rates coming down over the next year. Short-term yields are coming down quite quickly. We've seen the spread between the 10-year and the 2-year double over the past month. So as we see those short-term interest rates come down, everybody was using them as a haven for safeguarding their money and getting that risk-free rate. So we're really going to see a lot of investors moving their money over into stocks. And we do see both growth and value going to have a positive 2025. Clearly, growth has outperformed on the equal weight S&P by roughly 50% this year. And we're looking to see that rotation into value over the next year. And we still have an outlook of 7,000 for the S&P 500 at the end of 2025.
In terms of that rate story that you mentioned, we heard from Mary Daly a little bit earlier saying she's comfortable with 2 rate cuts in 2025. But considering the strength of growth, the strong jobs market in the US, the consumer's in good shape as well, and inflation's fairly sticky, and the uncertain political environment, is there a risk that we could see perhaps less than 2 rate cuts?
Absolutely. I think we could see anywhere from 1 to 2 cuts. I don't see a circumstance where there's no cuts at all. But like you said, growth has been performing quite well. Inflation has been holding steady. Consumer spending is still quite high. And as we know, the U.S. economy GDP is supported by 75% consumer spending. So we don't need these rate cuts right now. Even the past 25 basis point cut on Wednesday caused turmoil. We don't need another rate cut. The economy is doing well, and I think 1 to 2 cuts next year will be most appropriate.
Yeah, does the market need those cuts either? Because you just mentioned you've got a 7,000 price target for the S&P. Are we back in an environment where good news actually means good news?
I think so. And I think at this point, we are kind of battling the stretched valuations with these rate cuts. And so if we're not needing these rate cuts and we're still growing, that's a great sign for the economy. I don't think we could ask for anything more. And with the bond yield starting to come back to normal, we've been in an inverted yield curve for the past few years. And seeing that come back to normal, seeing the 10-year really steady at 4.5, I think it's going to lend to a strong stock market for the next year to 4 years, like you said.
Mm-hmm. Now, in terms of some of your sector-specific calls, I know you're quite bullish on healthcare, tech as well. You're not alone there. A lot of investors really like that AI story. But I'm interested, how about energy companies? Because, of course, AI is very energy hungry. Are there any names that you like in this space?
Energy we are looking at, obviously, with Trump 2.0 coming in next year, we will see more drilling, and we are positive on energy, but at this point, no specific names, but we are going to still continue to keep a neutral rating on energy moving into 2025.
So you mentioned that you prefer the US to the rest of the world, but were you to look at markets outside of the US, which market do you feel is least exposed to overseas trade risk?
So overall, we like to keep less than 10% in non-US stocks. And so clearly with China, we've seen the production growth outpace sales growth by over 2%, and that's been happening for over a year. With the tariffs coming in next year, even though we don't know what that full context is, I do think it's going to have a more negative effect for China than, say, Japan or India. We also look at, say, Europe, and we're seeing issues with Germany and their deficit in GDP. So I think a couple winners could be India and Japan moving into the next year.
In terms of your lack of enthusiasm for China, I mean, one thing that you can say about China is that the government's always prepared to step in and offer some support to the economy, markets as well. And we've seen, because of that region, China outperforming its peers in the region. Would that encourage you to add risk there or no?
No, like I said, usually we like to keep less than 10% in non-US stocks. And actually over the past year, we've been actively reducing that. And a lot of that just has to do with Trump 2.0 coming in and seeing what this is really going to look like. At this point, we would not be adding to China.
Well, certainly just in the past few days, I mean, President Trump's not even in the Oval Office yet, and he's, well, reminded us all of his capacity to surprise with remarks around the debt ceiling, Panama, the willingness to meet Putin, just to name a few examples. Does this give you a sense that we might be heading into a state of some volatility in 2025? And if so, how are you planning to hedge around that?
We do agree. And I think moving into next year, even the next 3 months, we're really going to find out what this new regime will look like. And so part of that is that rotation into, say, value stocks and some sort of hedge against some of the large growth. And, you know, even with bonds, you can take a look at floating rate bonds and see if that could be a hedge as well. So we definitely are looking at options and what we can do to protect if there, say, was a, say, geopolitical risk or something of that nature that occurs.
All right, Clark Geranen, Chief Market Strategist at CalBay Investments. Thanks so much for joining us. Just want to check in on crypto assets as well. Of course, they had a huge run-up following the November election, but seeing a little bit of a reversal now. Bitcoin back below quite firmly that $100,000 level. We've seen Bitcoin, in fact, experience its first weekly decline since the US election. It was down more than 7% for the week. That softness attributed to the Federal Reserve's cautious policy outlook. So that's tempered a little bit of optimism that we were seeing in the crypto sector. Other cryptocurrencies as well showing a little bit of weakness also. But Bitcoin just above 95,000 at the moment. We have more to come on the Asia trade. This is Bloomberg. Let's take a look at how US futures are tracking, broadly higher at the moment, and we did see a positive finish to the week for all of the major US indexes. We saw yields retreating a little from some of the highs that they touched last week as well. We got the rate-sensitive two-year yield there just a shade above 4.3%. We do have swaps traders now pricing in about 39 basis points of total Fed cuts next year. That's less than the two suggested. We heard from Daly a little bit earlier as well, saying that she is comfortable with two rate cuts in 2025. We saw inflation numbers coming in a little bit softer than expected as well. But of course, Jay Powell has warned in the past that last mile for inflation might end up being a bumpy road. Well, Donald Trump, meanwhile, still a month away from taking office, but he's already sending shockwaves around the world. Panama's president has disputed Trump's claims that US vessels are being charged exorbitant fees on the Panama Canal. News desk editor Jill Desis joins us now for more. And Jill, we've since had President-elect Trump respond to those claims from the Panamanian president about canal fees and the chance of the US repatriating the canal with the words, "We'll see about that." Where's this heading?
Yeah, Paul, well, I mean, look, there is actually quite a bit of nuance here. What it seems that Trump is really upset about, in addition to whatever he calls these exorbitant fees he says vessels have to pay, is also he's made this allegation that the canal, he doesn't want the canal to fall into the wrong hands. He mentions China. This seems to be something of a reference to the fact that while the canal is controlled by the Panamanian government, there's ports on either side of the canal, a couple of which do fall under the control of a Hong Kong-based company. So you've got it seems some concerns on Trump's part about this idea that other governments, including China or whomever, may be able to exert more control on the canal because of those types of placements. At least, again, I'm drawing a couple of inferences here, but that seems to be the direction that Trump is really taking this. Of course, it's not entirely clear what Trump or the U.S. would be able to do. There's some treaties that imply that maybe the U.S. would be able to use military force if there were concerns about the neutrality of the canal. But again, that has to do more with the neutrality internationally of the Panama Canal and not actually taking it back under U.S. authority. But, as we've seen with Trump over the last several weeks since he won election, he does have quite a habit of sort of, ruffling some feathers worldwide. And we've seen that kind of spill over into, some concerns among, other governments, including several U.S. allies, about how exactly to, sort of address Trump once he actually does take office in January.
Yeah, there's also been some commentary circulating about the role of Elon Musk in this government, particularly about, considering how that shutdown and funding deal got sorted out towards the end of last week. Now, Trump has since denied that he ceded the presidency to Musk, which seems like another extraordinary thing to say. We've got two very big personalities here. How is this going to play out?
Yeah, I mean, I think it's interesting just the fact that Trump seemed to feel compelled to even say that Elon Musk doesn't control the presidency. I mean, look, yes, you do have two big personalities that are kind of, jockeying for some influence here within the administration. Elon Musk, of course, he does have a role within the Trump administration, whether that be as an informal advisor or what have you. He's actually part of this new sort of non-government agency. It's an efficiency department, that Trump's put together, which operates out of a SpaceX office in Washington, D.C., trying to find ways to eliminate government waste. But we did kind of see this come to a head a bit during the debate over this the government funding bill. There was a slimmed down version of this bill that finally, as you said, did get passed over the weekend, but of course not without quite a bit of consternation ahead of then. It was again supposed to be a week where there wasn't going to be a whole big fight over a government funding bill. They were supposed to just pass something and just kick this off to March. But as we saw, there was quite a bit of drama there. Of course, Elon Musk was certainly a part of that. We'll have to see how exactly that relationship between these two men, kind of unfolds once Trump is actually officially in the White House.
Yeah, well, getting some news of some actual official appointments as well. Among them, Mark Burnett, Special Envoy to the UK. He's the creator of The Apprentice. I'll be fascinated to know how that's received in the British corridors of power. But also Stephen Mirren, a former Treasury official. He's going to head up the Council of Economic Advisers. What do we know about his role and the influence that he's going to have on US economic policy?
Well, ultimately, it kind of depends on the personalities for who ultimately kind of has, the most influence over these types of positions. You imagine that a position like the head of the Council of Economic Advisors is also sort of competing for Trump's ear, along with, the Treasury Secretary to some extent, the Commerce Secretary. We've seen, figures like, say Gary Cohn come into this position during the first Trump administration. So it does all kind of depend on how all of these personalities kind of interact within the White House. But ultimately here, Paul, what we've really seen Trump establish, with these advisors, these cabinet nominations, and all of these other political appointees that he's put together these are mostly people who are incredibly loyal to the president, don't really seem like they, necessarily want to come in as some kind of big counter outside voice acting against Donald Trump. I think quite different from what we saw during the first Trump administration, where you did kind of see more establishment figures kind of brought in to keep a check on Trump in a way. Obviously, several of those kind of failed pretty spectacularly. So, we'll see how all of these guys kind of interact with each other. But ultimately, it does seem like it's quite a lot of loyalists that are coming in, accompanying Trump here.
Jill, just before we let you go, what are the chances of a Trump-Putin meeting with a view to ending the war in Ukraine early in the term?
Well, Trump has said that he thinks that, that Putin wants to meet with him. We'll see what ultimately happens there. But, obviously, bringing an end to the war in Ukraine has been something that Trump has, kind of pointed to as a big thing that he wants to get accomplished here. I think, a meeting with Putin would be somewhat instrumental to making that happen. So if that's something that Trump is pushing for, he's claiming that Putin, does want to meet with him. That's, potentially a very likely possibility. Depends on how things kind of unfold over the next several weeks.
All right, news desk editor Jill Desis there. Let's check in on how futures in Europe are opening at the moment. We have stocks 50 futures in slightly negative territory right now. In fact, all of the futures boards a little bit lower. And just in terms of the Trump-Musk story, senior German lawmaker Dirk Weiss has criticised Elon Musk's interference in German politics. This is after Musk suggested that the far-right Alternative for Germany party was the country's only hope, which breaks long-standing traditions of not commenting on other countries' domestic politics. So we've got stocks futures, DAX futures, bond futures also all pointing lower at the moment. More ahead on the Asia trade. This is Bloomberg. Let's take a look at what's going on in the bond space. We're seeing yields on US Treasuries giving up some of the gains that we've seen. Yield on the China 10-year there at 1.7%, just above that. It's been a difficult year for bond traders, pretty much everywhere, experiencing unusual losses due to the Federal Reserve's easing cycle. The outlook for 2025 not looking a whole lot better either, with potential turbulence from the incoming Trump administration, rising yields, monetary policy. It's all going to make a very difficult navigation for the bond market. Investors in China, meanwhile, though, continuing to buy the dip even after the PBOC issued a warning following a record-setting rally in sovereign debt. For more, let's bring in our China correspondent, Min Lo. So, Min, where could we see yields go from here?
Well, some banks, including Standard Chartered, for example, say that yields could go down further to 1.5, 1.6% by the end of next year. But there are other economists saying that the yields could go back up to 2.2% levels on the back of reflationary measures. So a pretty split sentiment, but at least in the short term, this month, for example, we have seen yields falling every single day except for 4 days after the PBOC made those warnings against aggressive buying in the market. We saw yields climb for just 2 days before investors started buying on that dip again, which shows two things. Markets had already priced in the potential interest rate cuts. And number two, traders are really betting on potential stagnation in the Chinese economy, given the threat of tariffs, of a trade war, the uncertainty around the strengths of policy support, as well as the weakness in the property sector, the consumption sector as well. So we've been hearing the story repeatedly throughout the year. Traders really going head-to-head with the PBOC when it comes to those yields. We could continue to see those downward pressure on the yields going forward.
You mentioned the troubles in the property sector there as well. We've got some more companies now at risk of default. What's going on?
Yeah, China Vanke is the latest. We're hearing that banking regulators are asking insurers to check their exposure to that company, which shows that this company is on the radar for potential defaults. And this is the fourth largest developer in China that has so far avoided default. It shows that the crisis in the property sector is continuing now into the fifth year. If you look at the chart there, the amount of defaults has been coming down since the peak in 2022, but it still remains quite elevated since the crisis began in 2021. And the fear is that that contagion could spread to Hong Kong as well, because you have New World Development, a Hong Kong developer, also asking to delay payments on some of their maturing loans. Some of the heaviest debt burdens that we have seen. They have $28 billion in liabilities as of June. They're facing the first annual loss in 2 decades. And there you go. You can see the dollar bonds for Vanke has been slumping, which shows that there are increasing doubt from traders about whether they can actually get full redemption on these bonds.
All right, Bloomberg's China correspondent Min Lo there. Let's take a look at what's happening on FX markets in the meantime. Dollar strength continuing to be a theme. We've seen more gains for the dollar spot index. The yen off some of the lows that we saw last week where it broke through that 157 level, 156.47. We, as expected, did hear from the currency chief in Japan warning on Friday against currency speculation and hinting at possible intervention. The government in Japan has spent almost $100 billion supporting the yen this year. One anticipates they might be spending a bit more in 2025. We're also keeping a close eye on euro-dollar and some speculation that might be headed towards parity, certainly going in the other direction at the moment. Let's get to some other stories that we're following. Taiwanese President Lai Ching-te facing growing challenges to his leadership amid tussles, and we mean that literally, between his ruling DPP and opposition parties. Members of the DPP there on Friday piling up furniture to block the entrance to the legislature in Taipei. Even so, opposition parties managed to push through new amendments, including a law that could make it more difficult for the Constitutional Court to strike down legislation. A German judge has ordered pre-trial detention for a man suspected of driving a car into a German Christmas market. The incident left 5 people dead, dozens more injured. The 50-year-old man has been identified as a doctor of Saudi Arabian origin who works in the region. Authorities are investigating his potential motives, including earlier warnings from Saudi Arabia. UK Prime Minister Keir Starmer's pursuit of closer ties with China to boost the British economy is raising private questions from officials. Sources say President-elect Donald Trump's team, as well as European diplomats, are questioning his stance on China. Last month, Starmer became the first British Premier to meet Chinese President Xi Jinping in 7 years. We have more ahead on the Asia trade. This is Bloomberg. San Francisco Fed President Mary Daly says she's very comfortable with 2 rate cuts in 2025. She told Bloomberg that Donald Trump's proposed policies will not be the factor that guides her forecasts.
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we are prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that there's two things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress has just slowed relative to what we had wanted. But that's a typical pattern. It's bumpy. As you get to the, from 2.5 or 2.8 to 2, it's just a bumpy path. Go ahead, please.
But at the same time, some people were wondering if there was this stickiness. And I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. Remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. Was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We've practiced that where with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
San Francisco Fed President Mary Daly there. Let's have a look at how we're tracking on the major indexes that are open here in Asia. It's a positive day mostly. Every major index, be it Japan's, Korea, here in Australia, we're better by 0.5% at the moment, reversing some of those losses that we saw towards the end of last week after the Fed's hawkish cut. Got the MSCI Asia Pacific, meanwhile, better by 1/3%. Right, let's talk about consumer loans in Japan, rising at the highest rate in 16 years, and personal debt is overwhelming an increasing number of Japanese. Higher interest rates and the rise of cost of living biting there. For more, let's bring in Kazunori Takada, joining us now from Tokyo. So, Kazunori, we've got consumer loans rising at the highest rate in 16 years, but, as mentioned, this isn't a sign of confidence, is it? Can you tell us a little bit more about the cost of living crisis, and are we seeing a corresponding rise in bankruptcies as well?
Yes, so as you say, the higher cost of living in Japan, similar to what we're seeing across the country, across the world, is starting to hit on this data front. As you say, the personal individual bankruptcies are forecast to hit its highest level in more than 10 years. And one of the side effects of that is that we're seeing a higher number of suicides in Japan, people taking their own lives because they're unable to pay back debt. Mind you, one of the interesting things about Japan compared to other countries is that this is a country that's noted for very high level of savings with very low credit or debt levels. But that pattern is changing because, according to what analysts are saying, that they are struggling to basically find money to fund their day-to-day lives, so they're turning to consumer credit to support that.
So what's happening with wages growth in Japan? This is obviously not doing a lot to help with the cost of living situation.
Yes, the cost of living is seen to be picking up faster than the actual income increases that we're seeing. The average income in Japan is one of the lowest in the G7 countries relative to debt. And so what's happening with higher interest rates coming in, and they're forecast to rise next year, this will only make things worse because the level of credit will probably rise faster than the average household income.
Can you tell us a little bit about the social stigma around bankruptcy in Japan? How is this playing into the crisis?
So many people have been reluctant to declare bankruptcy, personal bankruptcies, because they feel that this will basically plague them for the rest of their lives. Obviously, there are restrictions once you file for personal bankruptcies, and that's one of the reasons cited for why people actually turn and take their own life instead of going through this procedure. However, over the years, the government is trying to increase financial literacy, to understand people understand what type of risk they're taking when they're making financial decisions such as this. But I think compared to, say, most other developed countries, that stigma is still very well entrenched.
All right, Executive Editor for Japan and Korea, Kazunori Takata there. Well, Japan's economic rebound and tourism boom are fueling a growing demand for luxury goods from both locals and tourists alike. That's according to Bulgari CEO Jean-Christophe, who spoke exclusively with Bloomberg's Haslinda Amin about growing optimism in the country.
I think the new generation is really today somehow rebelling against a sluggish destiny, which was more or less the history of Japan up to 5 years ago. You can see again in Tokyo now cranes all over the city, a lot of real estate projects. We are just opening soon, a store in the new district, Abu Zedai, which is very promising. Right. So Japan is entering, I think, a new cycle together with a new generation where people really are more bullish somehow and more willing to enjoy life at its fullest compared to the previous generation. So we see a surge of Japan, combined obviously with a lot of tourism in Japan, and not only Chinese tourism, but also, a lot of American tourism, of European tourism. So Japan is kind of the place to go nowadays for most of the world population. And it's not only yen related. The yen, we know, is quite weak, but also because it's a wonderful country. In terms of hospitality, you even have a Bulgari hotel. So it says long about how good it is to go there. But you have a lot of history, you have a lot of arts, of culture, of gastronomy, and people are very welcoming.
Jean-Christophe, which of your products are seeing the best growth? You're in everything from jewelry to watches to handbags. Which products are selling the best for you in terms of the luxury goods that you're selling?
Well, for Bulgari, it has been a year, I would say, of high jewelry and high-end watches in terms of growth category with the highest growth rate. And we still have some events, till the end of the year, so it makes me optimistic. Then it has been a year, I would say, also very much driven by Serpenti, which is one of our icons. From regular jewelry to high jewelry, it's becoming really more and more, a key symbol of Bulgari, and it is globally attractive to clients, which is rare because often some icons can be very popular in one geography and a bit less in another one. So Serpenti has been driving our business, but not only in jewelry, but also in watches, recording their best year ever, and in handbags, which you were mentioning. So those have been key drivers.
Bulgari CEO Jean-Christophe there speaking to us exclusively. And you can hear more from that interview later on Insight with Haslinda Amin. We have more ahead on the Asia trade. This is Bloomberg. All right, it's a positive start to the trading week on most of the major indexes here in Asia. We've got the Nikkei better by almost 2/3% at the moment. And take a look at those car makers on the right-hand side of your screen there. Honda up better by 1.2%. It did suffer a little bit upon the announcement of the news of its potential tie-up with Nissan. Nissan also better by 1/3%. Toyota higher too. We've got a Bit of news as well on the Honda-Nissan tie-up. We've got the presidents of both companies visiting the Ministry of Economy, Trade and Industry today. That meeting with ministry officials to report that they will be entering into business integration talks. Well, Carlos Ghosn, meanwhile, the architect of the Renault-Nissan alliance, says the merger talks between Nissan and Honda suggests Nissan is in panic mode. He told Bloomberg that while there are similarities between the firms, cooperation is going to be challenging.
It's a desperate move. It's not a pragmatic deal because, frankly, the synergies between the two companies are difficult to find. There is practically no complementarity between the two companies. They are on the same markets. They have the same products. The brands are very, very similar. So in a certain way, from one side, Nissan, it's a desperate move to try to find the future. And from the other side, Honda, which, if I understand well, they were not very excited about this move. But, you know, you have to count with Meiji in Japan. That means the Meiji had a big say into it. So at the end of the day, they're trying to figure out something that could marry the short-term problems of Nissan and the long-term vision of Honda.
Do you think Nissan is being put? Do you think Honda is being pushed into this deal by the economy ministry? There's politics pushing this deal, Carlos, rather than the value of the deal.
Without any doubt for me, that means having lived in Japan for so many years, I understand how influent can the Meiji be. And I can tell you that from all the data that I received about the performance of Nissan, which has been miserable for the last, at least for the last 2 to 3 years, they have cash problem, they have investment problems, they're being really hammered in the United States. They got practically out of Europe. They're being challenged in China, and there is no plan in front of it. So I can tell you that there is panic mode inside Nissan.
You've dealt with the Japanese, you've dealt with Nissan, you understand the metrics to get these organizations together. Is the government going to have to deliver backstops to Honda to make this deal work?
No, I think they in a certain way, tried to push Honda onto this deal. Obviously, Honda must have some kind of benefit out of it, if not on the short term, at least on the mid and the long term. But that will be closely monitored to make sure that the impact on the Japanese society is not going to be too big. Because, you know, when you have two companies of this size and practically in the same market with practically the same strengths and the same weaknesses, there are going to be a lot of costs to be taken out, and there are going to be a lot of duplication to be taken out. So this is going to be closely monitored by the Meiji.
It's driven by the Ministry of Economy. So there's a political dynamic to this. Is this Japan creating, putting two companies together to really try and stand up to the competition from China? Is that part of the narrative here, Carlos?
Without any doubt. It makes a lot of logic. Today, the Chinese automaker are on the winning side. They became, as you know, the largest exporter of cars. They are the largest maker of EV. They are being successful in a lot of new technology. They're doing fine cars. So in a certain way, yes, it's a defensive mood. It's a defensive mode that's going to be trying to shore up the Japanese industry and avoiding a cataclysm, first a social cataclysm in Japan, and particularly to try to reinforce these companies on the foreign markets.
That's former chairman and CEO of the Renault-Nissan-Mitsubishi Alliance, Carlos Ghosn. Well, SoftBank is preparing to bet big on AI, and part of that has to do with the company investing $100 billion in the US. That's the focus of today's Big Take. Our technology editor, Mayumi Negishi, joins us now. So, Mayumi, what's Masayoshi Son trying to do, and why?
The short answer is that Masayoshi Son wants to bring AI everywhere. He sees ARM as central to that push. ARM it has this energy efficient architecture that was really key to bringing big processing speeds to smartphones and small battery operated devices. And he thinks that ARM will also be central in this push to bring AI to inside our homes, on the road, in our pockets, everywhere. He sees Nvidia's big rise as the AI accelerator provider in data centers, and he wants to bring that power beyond the realm of data centers. And he's preparing to mobilize whatever he has. Our reporting, one of the amazing things in our reporting that we heard was that Son sees this AI chip move as, it could be 0.5% of SoftBank's next direction, or 50%. That's kind of indicates how big he means to go on this.
So what is different this time around compared with the Vision Fund?
First of all, I'd like to say that we do need to view all these big 100-year plans, that Masayoshi Son brings with a healthy dose of skepticism. This is, bringing on AI chips. That's Masayoshi Son has proven himself time and time again as a great operator, but he's really never been tested in the realm of nanometers and clean rooms and the manufacturing process of these tiny semiconductors. That said, what the big difference this time is that one, we have a very humble Masayoshi Son who's been burned through the Vision Fund's WeWork. He does not want to be associated with WeWork anymore, and he's ready to build his legacy again. And two, he listens. He listens to the technological feedback, the expertise that he gets from people in ARM, primarily CEO Rene Haas. I think precisely because this is a realm where he's been untested, in the realm of semiconductor manufacturing, that he's forced to listen to the engineers, forced to listen and take in account the manufacturing limitations that there may be ahead of him.
Is this skepticism you describe part of the reason why Nvidia might not be feeling particularly threatened by this?
No. I would say that most old hands in the semiconductor industry kind of see SoftBank's ambitions with a touch of bemusement, in part because it's such they understand the manufacturing and technological hurdles that SoftBank will face going forward. AMD has tried this. They are without doubt the closest to Nvidia, and yet they still haven't made a dent in the market share or revenue share of Nvidia's. That kind of attests to the monumental challenges that SoftBank is facing right now. Still, Masayoshi Son is now 67 years old. He is painfully aware of the legacy, and he is really ready to bet the house on this. I remember he used to say, I give what have I accomplished so far? I don't want to end up as an operator. And he really, this is going to be, I think we should be prepared for some big splashes ahead.
All right, technology editor Mayumi Nigishi there. And you can read the full story on that on today's Big Take on the Bloomberg terminal or by heading over to Bloomberg.com. Let's get you an update on what's going on with Nissan and Honda. NHK now reporting that the two companies aim to reach a final pact on their merger in June. As we mentioned earlier, the presidents of Honda and Nissan went to visit the Ministry of Economy, Trade and Industry to speak to officials there about their business integration talks. All of those major car makers moving higher in trading in Japan. We have more ahead on the Asia trade. This is Bloomberg. Singapore's main stock index is on track to have its best annual performance since 2017. That's likely to be overshadowed, though, by doubts about what lies ahead. For more, let's bring in Asia Stocks reporter John Cheng. So, John, why aren't things looking so rosy for the Singapore Exchange despite the outperformance that we've seen this year?
So on the surface, Singapore stocks are having their best year since 2017, and it's indeed outperforming other ASEAN markets. But if we take a deeper look into the STI's outperformance this year, it's mainly driven by banking stocks, namely DBS, UOB, and OCBC. And the outlook for Singapore banks next year is looking pretty mixed because we're entering an easing cycle, and that means their net interest margin will likely be squeezed. And also more broadly for the Singapore Stock Exchange, there's only been 4 IPOs this year, and which is the lowest amount in about a decade. And a lot of companies have decided to go overseas to list, and the listings are constantly outnumbering listings. So that on that front, the listing pipeline is not looking great at all. And so there's certainly a great need for the Singapore government to change things around this time.
Yeah, so how about the Singapore government's plans to revive the stock market? How's progress there?
So in August, MAS, the Monetary Authority of Singapore, announced a review group to sort of look at possible ways to revive the stock market. And this is the first high-level committee that the Singapore government is driving. So there's been a lot of hope and optimism around the committee. So so far, the deadline is set to be next summer, and they will come up with an action plan to sort of recommend some measures to improve the market. But there will be interim reports on the potential measures that they're considering. And so far, we're hearing from sources that there might be a state-controlled fund to sort of boost liquidity in the market.
Right. Okay. Asia Stocks reporter John Cheng there. That is it for the Asia Trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. This is Bloomberg.